Welcome to Buy, Hold, Sell. My name's James Marley. Today I'm joined by Roger Montgomery from the Montgomery Fund,
James.
Roger, and Steve Johnson from Forager.
James.
We've got two value investors here today to help us talk about looking for value in the current market. It's been a bit of a dour start to the year, but that doesn't mean there's not value out there. Today we're going to talk about some stocks and the fundamentals and how this broader economic malaise is impacting them or not impacting them. Roger, I'll start with you.
Sure.
2015 you carried plenty of cash. We've been told to sit back, wait for the opportunity as value investors. What are you seeing from the fundamentals of the companies? Is this economic noise impacting the individual companies you're looking at?
Well, it's impacting companies more broadly. There's no doubt about that. And in fact, when we look at the companies that have reported so far, they're missing guidance in many cases. I don't know whether that's a company's fault or the analyst's fault who had the estimate in the first place. But nevertheless, they're generally missing. But what we've noticed, and we track a portfolio of very high quality businesses going back a decade, and we compare current prices to their average valuations over that 10-year period. And at the moment, they're still, even the high quality companies, a little bit expensive. If you remove that period through the bottom of the GFC when everything was extremely cheap, if you remove that period, they're about fair value at the moment. So there's not a lot of bargains around at the quality end of the spectrum where we're looking.
Okay. Steve, from what we've seen in reporting season so far, the commentary from management that you've observed, is there anything to suggest that the operating environment is deteriorating?
I'm not seeing a lot of that, no, but the commentary is consistent with what we've seen for a few years now, which is that life is pretty tough out there, particularly at the top line. And I think we've seen a lot of profit growth in recent years that's come from cost cutting, and there's only so far you can go with that. We haven't seen a lot come from top line revenue growth. And I think, touching on what Roger's talking about there, the market is really rewarding companies that can grow their revenue and can grow their profits, and they're trading at quite high levels. If you're not in that basket, there's a bit more opportunity out there. And we probably operate across the spectrum from high quality to some lower quality businesses, and we're finding a lot more opportunities in those lower quality businesses trading at extremely low prices. And we've had a pretty good run of that over the past 12 months. So this type of environment is very good for us.
In August last year, you wrote a piece on our website. The index had fallen to around about the same level as it is now, and you said this is the time where, as a forager, you can start to move up the quality scale. Is that the approach that you would take now, or, as Roger said earlier, is the quality stuff still quite expensive?
Yeah, our approach historically has been, when you go through a real market meltdown, the first stocks that are going to recover out of that are generally the better quality ones. So you've been able to invest in those better quality businesses, make money out of it, and come back and find some of the stuff that's been left behind and make money again. We're not seeing that, and that's why I wouldn't call this a meltdown in terms of the market. I think the market is still behaving quite rationally, and if you're producing good results and good profits, your price is bid up. So I think it's actually a difficult time to do that, and what we're doing is recycling out of some of our stuff where we're making money into other stuff that's been similar, to be honest with you, which is at that lower quality end of the spectrum.
Roger, you commented earlier that you thought 2016 so far has actually been tougher than 2015. With prices having come off somewhat, do you start putting cash into the market now, or is it a case of being patient?
No, you have to wait. The index is dominated by large cap, mediocre businesses. 44% of it is BHP, Rio, the banks, Woolies, Wesfarmers, Santos and Telstra. And none of those businesses have particularly bright prospects. You know, they're not going to grow rapidly. Their payout ratios are very, very high, suggesting they're not reinvesting for growth. And so you would expect that one of the dumbest things that you could do in 2016 would be to buy an index fund, particularly on the ASX 200. So, you know, it's going to be tough for retail investors, particularly who tend to invest in the big, well-known names. Their results aren't particularly promising.
Okay. You did mention earlier that you have started to increase and take on some holdings in the banks. Is that just purely on valuation grounds?
Purely on valuation. The banks themselves have said that credit growth is not going to be as strong going forward as it has been in the recent past. By the way, that's a warning to property investors. Their payout ratios are going to remain at 70 or 80%, which means that they're not reinvesting through credit growth. And so that suggests that property prices are probably limited. Because of that, any risk to the downside or any perception of downside risk in property, the banks will probably be sold off again. So it's not a big position for us. We're definitely very underweight in the banks, and we'll add to that as prices become cheaper, because we heard yesterday the 24th million person was born in Australia, and by 2050, in 35 years, the population of Australia will be 40 million people. And on an island with growing numbers of people, banks are great businesses to own. So their long-term future is very good, but the short term is somewhat mixed.
Steve, you have a view that the banks in the short term have got a bit of a challenging outlook. Is there a point where they get interesting?
Look, that wouldn't worry us one iota. We buy a lot of businesses with challenging short-term outlooks, and often we take on that liquidity from the market because people don't want to own it with a 6 or 12-month view. We like to buy with that view and then own it out the other side when people start changing their minds. So that's not really our concern with the banks. And to be honest with you, I think because of the price pullback, the ledger is much more balanced to us today than it was, in terms of there's some value here. There are wonderful franchises, profit-making machines that I think are great businesses. I still worry about a couple of things. More capital required, so I think that return on equity is going to come down. I worry about the property market and the impact that could have on the banks. And we own Lloyds in our international fund, and we sit there and every result we cop another provision for some sort of misbehaviour, and I think that's a risk in the banking sector in Australia. We haven't seen any big fines or penalties yet, but I think there are these conflicts of interest inherent in the business models where I look at their financial planning arms and I say, how long is it until something really big blows up here and there's a big financial cost to the banks because of that? So there's a few things that worry me on the negative side of the ledger, and the price hasn't fallen enough yet for me to get into.
Yeah, some of the growth over recent years has been because of write-backs of provisions for bad and doubtful debts, and so they're perhaps under-provided right at the top of the cycle in property.
Roger, as you look at the market today and you do start to screen for value, where are some of the spots lighting up for you?
Well, some of the smaller companies and mid-cap companies, but certainly not in the big-cap space, and not in the technology space, it seems, other than, there's one exception. There's a company called Altium that we quite like, and it still looks pretty cheap. But everything seems to, and REA, actually, believe it or not, looks reasonable, and I think the market misunderstands its exposure to a downturn in the property market. But other than that, there's just not a lot to get excited about at the moment, despite the falls.
Okay. You touched earlier on valuations in quality companies remaining relatively high against a limited selection.
Well, the prices are high.
The prices are high.
Yeah.
Is it okay to pay up for those quality businesses?
No. That's the short answer, James. Your return will be a function of the price you pay. The lower the price you pay, the higher your return. So paying up for them because of some belief in momentum or something like that is not something that we participate in.
Okay.
Yeah.
Steve, I'll throw it over to you. Looking for value, are the spots in the market, or is it on a case-by-case basis?
I think what Roger just touched on there is really important. And I think value investors get stuck in this range between thinking 10 times earnings is cheap for a business and 20 times is expensive. As you've seen with a business like Domino's over the past 4 or 5 years, if you get the earnings growth, 20 times earnings for a business can be cheap. And if you don't, 10 times can be very expensive in a business that faces problems. So I think you need to widen that range depending on the quality of the business. We've got a really well-balanced portfolio at the moment that I'm happy about. I think, and we've seen this a lot over the past few years, it's easy as a value investor to say, well, this stock's cheap and that stock's cheap and that stock's cheap, and they're all in the same sector, and you end up with a third or half your portfolio invested in resources or in banks or whatever it is that's looking cheap at the time. We've been able to construct a portfolio at the moment where we think we've got some really cheap stuff that's spread across a bunch of different sectors. So we own a couple of IT names, we own a couple of mining services names, we own one actual mining stock. We're just quite well spread in terms of the portfolio, and that's one thing that I'm optimistic about at the moment, that we don't have too much concentration to any one sector.
Okay. Well, it sounds like you're going to need to do some work outside of the top 20 to find your returns in 2016.